Joining us now for some market strategy is Aaron Smith. Aaron is the Managing Director at Superfund Financial here in Singapore, and Edith Touin, the Vice President of ABN Amro Private Banking. Thank you both so much for joining us on the show today. Aaron, I want to start with you. I was just glancing through your notes, and you're making the prediction that the market could possibly crash even beyond the levels that we're seeing now within the next 2 to 3 years. What could be the catalyst for such a move?
Well, certainly we could see market conditions which are even worse than what we see today. We think eventually Asia will lead the world out of the financial crisis, but the big question is what sort of time horizon to look at. And we look at least the next 2 to 3 years. That doesn't mean that we won't see rallies in the market. If you go back to 1929 to 1933, the market rallied over 20%, 6 times during the biggest losses, in all-time history for the Dow Jones. So we're going to see bear market rallies, but overall our sentiment is bearish, and we have continued to have short positions in most of the global equity markets, including some of the big indexes in Asia, which has led to our positive performance at Superfund.
Okay, Edith, I want you to jump in on this. Do you see investors getting consistently lured back in by bear market rallies and then getting hammered like Aaron is proposing?
Yes, I think the risk is very much there. We're still very cautious. We're still underweight equities. We focus on very much the defensive sectors where we still see good earnings growth. But on the more cyclical sectors, although there's some bottoming out going on, yes, there will be quite a few bear market rallies before we see a sustained upside for those sectors. And also a lot of them, once the market gets on its feet again, a lot of them have to repair their balance sheets, which will have a depressing effect on earnings. And with the more defensive sectors, especially the healthcare sector, that is not the case.
There's a lot of people, Edith, that think some of the defensive sectors are maybe overbought. What's it going to take to get you to get a little more risk appetite for the equity market?
Well, I do think the risk appetite is being whetted from time to time, but what we're seeing now in the more defensive sectors is these companies that have very strong balance sheets, have very high cash reserves, that they're actually taking advantage of what's going on with valuations in the rest of the market. So especially in the healthcare sector, a lot of M&A activities, also in the utilities sector, and that will of course revive the interest in these sectors and also drive valuations higher there, as the earning streams are very much predictable and, as I said, quite defensive.
Aaron, we've seen a little bit of a pullback in gold, but you like it. I mean, how much room do we have to run?
Oh, well, certainly gold in the next 2 to 3 years can go to $1,500 per ounce. Similarly, we feel quite bullish about silver. That would be a little bit more aggressive, a little bit more volatile, but more upside for silver as well. Basically, we're looking at real assets over paper assets. So stocks, bonds, these highly leveraged securities are going to be less favorable compared to real assets like gold and silver.
Aaron, are you buying gold? It's Rossi. Are you buying gold because you think there's going to be an inflation problem, or just because? I mean, what's the fundamental reasoning?
Well, certainly gold is actually the #1 currency on the planet today. That's the reason that we're buying gold, because gold for the last 3,000 years was the best way to store value. And whether you're in a deflationary period, inflationary period, it stood the test of time. So we feel very safe holding gold. We don't feel very safe with paper currencies, which aren't based on any real fundamental value. Unfortunately, we see the Treasury is, printing dollars at an unprecedented rate, which we don't even know the rate because the Fed stopped publishing the M3 data back in March 2006. So unfortunately, we don't even know how fast the money supply is growing. That's why we feel just safer owning real assets like gold.
Edith, are you worried about the money supply? Because the Fed said yesterday, of course, that look, we still got potentially a big deflation problem. We're not out of the woods by any means on deflation, are we?
No, certainly not. And as these latest write-offs with the banks show, that there's still quite a lot of asset values being destroyed. So therefore I see the case for gold as well. But again, not all asset values are being destroyed. Some actually gain in value by deflation. And we saw that in Japan in the big deflationary period, where secure earnings in defensive growth companies did well over years. And that could very well be the case here as well. So a strong focus on these sectors is really asked for.
Look, we had a rally in banks in the last 24 hours, particularly yesterday, when we started talking about this bad bank model, and you know, banks shot up quite a bit, Edith. But I wonder, George Soros today speaking to us said, look, I actually don't think that's quite the right way to go. What I'd like to see is a good bank created that investors can put money into. Where do you stand on the banks and this good bank, bad bank idea?
Well, I guess the good banks will have to be the banks that are going to repair their balance sheets from now on, and for that's still a bit too early. The bad bank, of course, is a repair measure that has to be taken, and that in the end will help the whole financial industry. But good banks right now, everybody is facing problems with credits basically going bad, not just with the corporate sector, but also in the consumer area. So that is an alternative which sounds nice, but is hard to realize.
Edith, we appreciate it. Edith Touin, Vice President with ABN Amro Private Banking, and Aaron Smith, Managing Director with Superfund Financial, joining us live in Singapore. We appreciate your time.